Trump just reset global trade in one move, and this could hit your wallet, your stocks, and even gold prices within months. And the next 150 days might decide where smart money hides. What just happened? All right, here's what just went down. The Supreme Court struck down Trump's previous tariffs. So what did he do? He pivoted immediately. He just imposed a new 10% global import tariff for 150 days using something called Section 122 of the Trade Act of 1974. This is important. Section 122 allows up to 15% tariffs. No long investigation required, can be applied to basically all countries. Lasts 150 days unless Congress extends it. Translation. Tariffs aren't gone. They've just been legally restructured. At the same time, the administration is launching new investigations under Section 301 and potentially Section 232, meaning country-specific tariffs could return, and possibly higher. So this 10% tariff? It may just be the opening move. Why this matters now? Here's why you should care. A global 10% tariff means imported goods cost more. Companies either absorb the cost, hurting profits, or pass it to consumers, raising prices, which means inflation pressure. And we already saw what inflation did to markets the last cycle. If inflation ticks up again, the Fed may delay rate cuts, financing stays tight, growth slows. And remember the April 2025 financing dip? Liquidity disappears fast when uncertainty rises. What happens to the USD? Now let's talk currency. Tariffs can actually strengthen the US dollar in the short term. Why? Because global uncertainty pushes capital into US assets. But here's the twist. If trade partners retaliate, growth slows, legal uncertainty drags on, confidence could weaken. That creates a tug of war, short-term USD strength, long-term instability risk. Currency markets will move before stock investors fully react. What about gold? Gold loves three things: geopolitical tension, policy, uncertainty, inflation fears. And we now potentially have all three. If inflation resurges and rate cuts get delayed, that's a stagflation-light scenario. Historically, gold performs well during uncertainty spikes, but if the dollar strengthens aggressively first, gold could dip short-term before moving higher, so volatility is likely either way. Stock market risk. Watch these sectors carefully. Import-heavy retailers, automotive supply chains, semiconductor manufacturers, tech companies dependent on global components. Margins get squeezed first, then guidance gets revised, then analysts downgrade. That's how trade policy slowly becomes a market correction catalyst. And remember, markets hate unpredictability more than bad news. Right now, we have legal battles, new investigations, possible retaliation from China, Brazil, Vietnam, Canada. That's multiple volatility triggers. Opportunities. Now, instead of fear, let's talk strategy. 1. Volatility trading. Trade headlines create price swings, options markets may light up. 2. Domestic manufacturing plays. If tariffs push reshoring, industrial automation, infrastructure, robotics could benefit. 3. Precious metals hedge. Small gold allocation can offset policy uncertainty. 4. Strong dollar positioning. Emerging markets may weaken if USD strengthens. 5. Defensive sectors. Consumer staples, utilities, healthcare tend to outperform during uncertainty cycles. Trade wars create chaos. Chaos creates mispricing. Mispricing creates opportunity. The big picture. The real issue isn't the 10% tariff. It's what comes after 150 days. If new investigations conclude with higher tariffs, we could see renewed inflation pressure, delayed monetary easing, slower global growth, increased geopolitical friction. This is not a single headline event. This is a 6-month macro setup. Summary. Trade wars don't just move borders, they move capital. And the next 150 days could decide where money flows next, into stocks, into dollars, or into gold. If you want updates as this unfolds, subscribe. Because policy shifts like this, they don't stay quiet for long. Don't stay quiet.